To be successful in stock market investing, there are several key principles and strategies you can follow. While there's no guaranteed formula for success, these guidelines can help increase your chances of making informed decisions and managing risks effectively. Here are some steps to get you started. 1. Education and research. Learn the basics of investing, understand key financial concepts, stock market dynamics, and different investment instruments. Study the companies you're interested in, research their financial health, competitive advantages, industry trends, and growth potential. Stay updated, keep track of financial news, market trends, and economic indicators that can impact stock prices. 2. Set clear goals. Define your investment goals, determine your financial objectives, time horizon, and risk tolerance. Establish a realistic investment plan. Consider factors like diversification, asset allocation, and investment strategies that align with your goals. 3. Develop a strategy. Choose your investment style. Decide whether you want to be a long-term investor, value investor, growth investor, or engage in other trading strategies. Consider risk management. Determine how much you're willing to risk on each trade or investment, and use stop-loss orders to limit losses. Diversify your portfolio. Invest in a mix of different stocks and sectors to spread risk and reduce exposure to any single investment. 4. Fundamental analysis. Evaluate financial statements. Assess a company's earnings, revenue, cash flow, debt levels, and profitability ratios. Assess competitive advantages. Look for companies with strong market positions, innovative products, and sustainable competitive advantages. Understand valuation metrics. Compare a company's stock price to its earnings, book value, and industry peers to determine if it's undervalued or overvalued. 5. Technical analysis. Analyze charts and patterns. Use historical price and volume data to identify trends, support and resistance levels, and other patterns that can guide your trading decisions. Apply indicators. Utilize technical indicators like moving averages, relative strength index, and MACD to spot potential entry and exit points. 6. Risk management. Set a budget. Determine the amount of money you're comfortable investing, and avoid risking more than you can afford to lose. Use stop-loss orders. Implement stop-loss orders to automatically sell a stock if it reaches a predetermined price, limiting potential losses. Stay disciplined. Stick to your investment plan and avoid emotional decision-making based on short-term market fluctuations. 7. Continuous learning. Stay updated with market trends. Continuously educate yourself about new investment strategies, market developments, and evolving regulations. Learn from your mistakes. Analyze your successes and failures. Understand the reasons behind them, and use these insights to refine your future investment decisions. Remember, investing in the stock market involves risks, and past performance is not indicative of future results. It's advisable to consult with a financial advisor or professional before making any investment decisions.